All right, let's bring on Tom Hayes here, managing member at Great Hill Capital. Welcome back on. How we doing, Tom?
I'm doing great, Mitch. Good to talk to you as always.
It's always great to talk to you. Of course, it looks like today we finally ran into the wall. Some might call it the January effect wall, is what I'm referring it to a little bit. It looks like, I have the question now, and I feel a lot of investors are asking this question. Is this more a pause in the recent action or more along stocks starting to show at least a reverse from the recent rally?
Yeah, it's a great question, Mitch. It's the $1 million question. I do think that we've had a 15% rally off the October lows. It's time to have a little bit of consolidation. The move is a little bit exhausted, but people are still off sides. And I do think after we get through this short-term consolidation, whether it's a week or so, the path of least resistance is higher. I think we'll consolidate short-term. And keep in mind, Q4 earnings season, although it just started, it's basically going to end in a few weeks, okay, after we get major tech earnings. And I think what's going to change about that is 2022 is no longer a factor. And then you have 2023 earnings, which right now are, 229.52, which is consensus. And people are saying, oh, well, if we're going to get slowdown, 17.2 times multiple is too high. But the minute those Q4 earnings roll off, we're no longer going to be focused on current year earnings. We're going to start looking forward to 2024 earnings, which are at 252.74. And in that case, we're only trading at 15.6 times 2024 earnings. And I think that shift is going to start to happen in coming weeks as we get through earnings. The other thing to keep in mind with earnings, Mitch, which is very important, everyone had very, very low expectations coming into this earnings season, negative 4.1%. But if you look at the Atlanta GDP now, it's saying that GDP grew in Q4 at plus 4.1%. So that dog don't hunt. Either GDP expectations are too high or earnings expectations were too low. And we think earnings expectations were too low. We're going to have a positive surprise to the upside. Guidance will be a little bit better than expected. And then we start to look forward to 252 in 2024. And that's when people start to say, wait a second, there is value here at 15.5 times. We'll have consolidated. And by then, maybe the Fed will be done with their hawk talk. We were doing just fine after PPI until Mester got on the horn and Bullard got on the horn and talked the market down this morning. That's the bad news. The good news is neither of them have a vote moving forward. So their words are pretty much meaningless.
All right. Now, one thing I have been looking at, of course, is that we've been seeing kind of the amount of layoffs continue to grow, right, in the tech. Are you concerned that this is going to show up further down into earnings, right? I mean, it just seems to kind of make sense. If they're laying off, do they expect trouble going forward?
Yeah, I think this is actually very positive because number one, they'll take the one-off severance, like you saw a $1 billion charge with Microsoft this morning. Yeah. But what you're going to see, and we talked about this in December, is you're going to see a slew of these announcements. Microsoft 10,000, Amazon you've seen, Salesforce you've seen, and you're going to see more and more, and they're all going to come in January because no one makes layoffs in December before the holidays. And what that is actually going to do that no one's really paying attention to is you're going to start to see political pressure heat up very, very quickly, particularly if you think about where most of these layoffs are concentrated in Nancy Pelosi's constituency in San Francisco and the whole tech area of California. And you're going to see politicians start to come out and really rail into the Fed. If you thought Trump was hard on Powell when he was in office, these Congress people are going to start coming out and say, you've tightened enough. It's evident that inflation has collapsed, is rolling over materially. You have to take into account the lagged effect. There's no reason that we should have hundreds of thousands of people laid off unnecessarily just for you to try to rectify an egregious error that you made last year by saying it was transitory and the Fed funds rate wouldn't go above 1%. It finished the year at 4.25%. We found out inflation wasn't transitory, and now you're overdoing it to the other side. So don't make two mistakes. One mistake was enough. You could actually declare victory, say we're going to keep rates elevated at these levels like they did from 1995 to 1999. They kept the Fed funds rate elevated at 6.5%, and tech did exceptionally well during that period. So they could keep rates elevated. Maybe they do another 25 basis points, and pause and keep it there at 450, 475, for 9 or 12 months, see how the economy absorbs that. And my guess is if they did do that and they stopped in time and created a soft landing, they could keep the Fed funds rate there for quite a long time, maybe many years. But if they go too hard, they're going to just have to cut again, cause a recession, and start all over, which would be an egregious error.
Well, it seems like you're in the camp of what the FedWatch tool is now showing, right? 94.3% probability of a 25 basis point hike at the Fed's next meeting. Of course, there was a lot of people still hawking on 50 basis points. So interesting to see that starting to get that high. Do you have that high conviction also, kind of more, I wouldn't say maybe 90%, but what do you feel about that outlook there?
Yeah, well, we've always been in the 25 basis point camp. They should do 0, but that would make too much sense. And why make one mistake when you can make 2? So they'll go for 2, and then they'll have to stop sooner rather than later. Maybe an intra-meeting announcement that they're going to pause as they see the data roll over. I mean, retail sales negative in December during the holiday season. I mean, you don't need to know a lot more. Manufacturing production came in worse than expected today. Industrial production came in worse than expected today. Retail sales came in worse than expected. PPI is negative 5.5% month on month. You annualize that, you're negative multi points there, and apparently they're just not getting the message yet. So hopefully by the February meeting, they'll be getting enough pushback from politicians that hundreds of thousands of layoffs are unnecessary, and they'll calm down, and they can keep it elevated if they want to keep things restricted. I think that's a good idea. Keep things restrictive. Don't get too easy too quickly, but you don't need to go much tighter than you are now.
I wonder, right, if Powell was kind of giving us a little bit more of that forward outlook with kind of his recent comments that came out of the conference, when he was saying that it's going to be like unwished decisions, like the decisions that he's going to be making moving forward aren't going to be some favorable ones. Let's hope that's not the case. Let's move forward. Let's get into an area that you've been all on top of, Tom. Definitely got to give you the shout out for that. And that's talking about the China trade, right? Let's talk about this. Is this pullback that we're getting today an opportunity, or has this trade gone too far?
In the long term, it hasn't even started. In the short term, it's got to take a breather and a consolidation. So, companies like Alibaba, which we've been buying for months and pounding the table for months, and averaging in, our last purchase was at $61. Our basis is higher. But we think that the intrinsic value of this, sum of the parts, when you look at the cloud business right now, is where AWS was, Amazon Web Service was in 2016. We think that's going to add another $10 billion of operating income to Alibaba, which would mean a 66% increase over their peak when it was trading at $319 a share. Moving forward. Then you got the Ant Financial IPO now that's going to happen within 12 to 24 months. They had the change of control. All the actions have been taken. That's the largest financial services business basically in Asia. And you own a third of that as an Alibaba shareholder. And then finally, the missing piece that is what catalyzed the trade was the dollar stopped going up. And that was the secret to emerging markets. The dollar's weakened about 10% in the last few months. And companies like Alibaba are up 95% off of their lows. Then you get Ryan Cohen, Mr. Meme himself, but also a multi-billionaire, step into the stock. We found out yesterday through the Wall Street Journal, he's bought a few $100 million of stock, and he's telling the company you should buy back more stock. And I'm adding to that, not only should you buy back more stock, you should stop buying back and then giving it out to management at stockholders comp, and respect equity holders. Do cash bonuses and let the buybacks be accretive to shareholders and increase earnings per share and drive the stock over the next few years. So to answer your question, it's probably got to take a breather after moving close to 100% in 2 or 3 months. Maybe that's days, weeks, I don't know. But when you look 2-3 years out, this is going to be a much, much higher stock, and it's going to revert back to its intrinsic value, which is meaningfully higher from here.
Yeah, there's not many stocks that you see a lot of the moving averages starting to even turn. You're seeing the 200-day start actually going to the upward angle. That hasn't happened in a long time. So we'll see what happens here, especially on, the overall China trade. You could look at FXI, similar, it gives you that outlook there. We'll look to see if we get some pullback opportunities here, Tom. Appreciate you being on top of this trade, definitely, and bringing it to the audience. Let's get out of the China trade. Let's continue. Let's talk about what's going on in Moderna. It looks like, of course, they're just putting out more kind of vaccines. They're not just COVID anymore. I think this is the important thing. What do you think about a stock like Moderna?
Look, we love biotech for 2023. We built up a position in late 2022. It bottomed in May. The sector bottomed in May of 2022, several months before the overall market bottomed. And we think our thesis was predicated on the fact, number one, we buy a basket because we don't think we can predict which company is going to get approvals when or which companies are going to get taken out. But when you buy a basket and the group is at historical low valuations, which it was in 2022 and still is, you can really, really benefit moving forward. So the two catalysts there are, number one is drug approval. So you've seen some major approvals in the Alzheimer's space, which means that you're going to see more and more money come in and want to get involved. You're seeing blockbuster drug approvals. Moderna has this special vaccine mechanism with the mRNA. We saw it with the recent approval last night. But we like the basket. We wouldn't want to put our money just in one name like Moderna, because all of these companies are going to be racing to the finish line. Vaccine first, but Moderna's was, it did exceptionally well also. So I think you just want to have exposure to the group because the group is historically undervalued. And moving forward, you're going to see a lot more drug approvals now that the FDA is focused on their normal actions. For 2 years, they were just focused on COVID. And you're going to see a tremendous amount of deal activity. Even in the slowdown in the fall, you saw major deal activity. Big Pharma is facing patent cliffs. What they have is a lot of cash on their balance sheets. What they don't have is a lot of growth moving forward. So when would be a better time to buy growth than biotech, which is trading at historically low valuations? And you saw a bunch of deals in late 2022. You're going to see a lot more in 2023. And that is going to drive more and more institutional flows into the biotech sector. That is a key position for us. We've got China, Alibaba, we've got that, and we've got some special situations in the US as well.
Love it. And I definitely like how you pointed out there the bottoming of the sector in 22. I know that you always like to stay in looking at that weakness to try to catch some opportunities. Any concerns for big tech earnings, or maybe this is a rotation that we should be looking at? I know a lot of people are concerned about these big techs. Are you?
There's none that I love except for Amazon. So Amazon is trading back at 2018 levels. We've been talking about Amazon for 4-6 weeks. It was down to 85. I think I don't know what it is today, 95. So it's just starting to move. But basically, you're buying at 2018 prices. The difference is the Amazon Web Service business has tripled over that period. Their ad business has tripled over that period. Their e-commerce business has doubled over that period, and their Prime membership has grown from 100 million to 163 million members, and you get it for the same price. So why is the stock trading like, Number one, interest rates went up very, very quickly. That's fine. But number two, they overexpanded warehouses during COVID. They thought that it was going to be an unending growth where people would stay home forever and never go back out to stores. That's unrealistic. So Jassy will fix that. He'll normalize the warehouse costs. As a matter of fact, there was an article that probably major layoff announcements are on the way. They'll take the one-time charge for the severance. That'll add to their margins. There'll be a leaner, meaner machine moving forward. And we certainly like Amazon. Now, if you look at the Bank of America Fund Manager Survey from yesterday, which I'm sure you saw, Mitch, managers, 750 billion of AUM, about 250 managers managing that, have their lowest U.S. equity allocations since October 2005, August 2010, and September of 2017. In all those three instances, you want to be a net buyer. The other thing that people are getting faked out with the general indices, if you look country by country around the world, many countries are at or near new 52-week highs. Mexico is breaking out. The UK is breaking out, which everyone says they have the highest inflation and the biggest recession. All of these countries are breaking out. There's only two indices that look like garbage right now. Number one is the NASDAQ, which is the five FANG stocks. And number two is Israel, which is a tech-based index. So ex-tech, everything else is in a new bull market. And what that means is tech will follow. It may slightly underperform, but many of these names have come down so much that their rebounds, even if they underperform the general indices, can be material. And that's why we like Amazon. We like the things that are left for dead. I mean, Amazon was down 55 some odd %, one of the best businesses in the world, historically and prospectively in our view.
Definitely appreciate you like always, Tom. I'll sneak one last in that I wanted to talk about, which is we don't do it too often, but the industrials, they've stayed strong. Specifically, we could talk maybe Deere and Cat that have really stayed strong, or we could just do the XLI, right? I mean, that's really been an area that I have seen strength as of late. Is this area an area that you're looking at this year, or is this more along just kind of a trade that has come maybe a little bit of a value trap waiting?
Yeah, I buy weakness and sell strength. I know there are a lot of traders out there that like to buy strength and sell weakness. The big money is made in buying weakness and holding for a few years, both from a tax standpoint and from an economic standpoint. So Cat and Deere and many of the industrial names have had huge runs last year. That's when we were interested in them. We're much less interested. If you have to be in the vicinity, we would actually look at some of the defense stocks that have gotten slaughtered this week on fears of the debt ceiling fights that they're going to cut the defense budget. The one thing that you need to know about politicians is where they get their money from. Defense is one area and pharmaceuticals is another. So I think the probability of them doing meaningful cuts in the defense budget, particularly given the geopolitical concerns we have around the world, are relatively low. Maybe there'll be modest cuts, but the way these things have sold off in recent weeks, I think there's opportunity in the Northrop Grummans of the world, maybe the Lockheed Martins, and that's as close as I would get to industrials. I mean, with Cat and Deere, they've had these monster runs. I'll leave that to someone else to play the breakout for a few points. I like to buy them when they're in the gutter, like Amazon and Alibaba, and make 200, 300, 400% over 3 to 5 years. That's more my style.
All right, the chat will kill me if I didn't ask a little bit about oil. What about that? I know that China's kind of reopening. That could help some of the demand, but is this more along something that has just gone too far, and we're going to see that rotation coming soon?
Yeah, I'm agnostic. We were pounding the table long energy stocks in 2020 when oil was trading at -30 and you couldn't give them away. That's when we buy them. We laid off early in 2022, probably a little too early, but you can't be a pig. And energy stocks would have to come in a lot more for us to reload, which we don't think is outside of the question. I do think certainly China demand will be material, but at the same time, the U.S. rig count is now just at pre-pandemic levels. So while everyone looks to Russia and Saudis for production, what they're forgetting is that our production, which had been cut by 66% during the pandemic, is now back at pre-pandemic levels. And that's recent news that, not everyone has in their models. So I do think China demand is material. I also think U.S. production is material. So we remain agnostic on oil.
Well, definitely, you guys in the chat, hit the thumbs up. I hope you guys appreciated that. Tom hitting every single area that I could think of to get into the markets today. Appreciate you like always, Thomas Hayes. Check him out, guys. Chairman and managing member, Great Hill Capital. And you guys can always give Tom a good follow. He's a great one on Twitter. Appreciate it, Tom.
Thanks so much, Mitch.
All right, let's get